Hey everyone, welcome back to another episode. In today's video, we are going to look at financial assets only, as per pre-IFRS 9, as per old IAS 39. Okay, so as always, let's start with the basics. What is the objective of this standard? It wants us to classify financial assets based on how we manage them, so that the measurement and presentation of those assets in the financial statements reflect how they are being managed and the risks that are being held. Okay, so let's take a look at what we have here. So there are three possible categories for our financial assets, right? Amortized cost, fair value through profit or loss, or fair value through other comprehensive income. Okay, so if you want to figure out where your financial assets should be classified, there are two main tests that you need to perform. First, you need to do the business model test. Then you need to do the SPPI test. And depending on your answers to these two tests, that's going to tell you where your financial asset needs to be classified. Now don't worry, I'll show you a table in a second. It's going to make way more sense once you understand what these tests actually mean. So the first test is called the business model test. So this test aims to identify how an entity manages its financial assets, right? It really looks at what the objective of holding that asset is. Are you holding it to collect the contractual cash flows? Meaning you're not planning to sell it anytime soon, or are you holding it to sell? Or maybe you're collecting some cash flows while also having the intention to sell. This is really about understanding the objective of why a company has acquired a financial asset in the first place. So if you want to keep it simple, there's basically three models that companies use when they buy financial assets. No, one is the collection model. No, two is the trading model. And number three is a combination of both. So depending on which model a company uses when buying financial assets, that's going to determine their classification. The second test is called the SPPI test. SPPI stands for Sole Payments of Principal and Interest. And this test aims to determine whether the contractual cash flows from a financial asset are solely payments of principal and interest. So what does that mean? Well, let's say you have a loan, right? A simple example would be a mortgage. The bank that issued the mortgage is receiving interest payments every month from the borrower. That's considered an interest payment. But then, at the end of the term, the borrower needs to pay back the principal balance. So that's a principal payment. However, if we look at the contractual cash flows of some other types of financial assets, they might not just be interest and principal payments. For example, consider equity investments. An equity investor might receive dividend payments from their investment. Now, dividends are not interest, they're really a distribution of profits. So therefore, this would fail the SPPI test, because it's not just principal and interest payments. Alright, so now that we know what these two tests are, let us take a look at the table in IFRS 9. It gives us the different combinations for the two tests and then tells us where the financial assets should be classified. So over here, if you're reholding financial assets to collect cash flows, and your contractual cash flows are solely payments of principal and interest, you're going to classify it at amortized cost and measure it using the effective interest rate method. You're also going to test it for impairment using the expected credit loss model. So as you can see, if you're holding it to collect and it passes the SPPI test, you get amortized cost plus the ECL model for impairment. If you hold financial assets to collect cash flows and you have the intention to sell them, plus your contractual cash flows pass the SPPI test, you're going to classify it at fair value through other comprehensive income, which means that any changes in fair value are going to be recognized in other comprehensive income. Now you will recognize interest income from these assets, as well as foreign exchange gains and losses, and you'll also recognize impairment losses on these assets. However, any gains or losses from changes in fair value are going to be recognized in other comprehensive income. Once again, these assets are also going to be tested for impairment using the expected credit loss model. So the third category is fair value through profit or loss. And this category captures all other scenarios. So if you're reholding your financial assets to collect cash flows and you intend to sell them, or if your contractual cash flows fail the SPPI test, you're going to classify your financial assets at fair value through profit or loss, which means that any changes in fair value will be recognized in profit or loss. Furthermore, if you bought these assets or made these investments with the intention to trade them, so you bought them for that purpose, you can classify them at fair value through profit or loss. Now these assets are not tested for impairment using the expected credit loss model. Instead, any impairment is recognized when there's objective evidence of impairment. Now, before we move on, there's something important that we need to discuss. When it comes to equity instruments, by default, they are classified at fair value through profit or loss. However, an entity may elect to classify these instruments at fair value through other comprehensive income, which means that any subsequent changes in fair value will be recognized in other comprehensive income rather than profit or loss. Now this election is irrevocable. Now what does that mean? Well, let's say you elected to classify your equity investments at FVOCI. That means that you cannot change your mind and decide to classify them at FV. The election is final. Additionally, dividends received from these equity investments are recognized in profit or loss. However, they are not recycled back from equity. The next question I often get is in regards to reclassification. Can we move a financial asset from one category to another? The answer is yes, but only when there's been a significant change in the business model. So let's say that you decided to classify a certain financial asset at amortized cost. Can you later change your mind and decide to classify it at FVOCI? Well, the answer is no. However, if there's a significant change in your business model, you can move it. So maybe you used to buy financial assets to hold them until maturity, but now you want to start trading them. That would be a significant change in your business model, which would allow you to reclassify certain financial assets. Okay, so hopefully that makes sense. So now that we understand the classification, where exactly do we recognize these financial assets in the financial statements? So when we buy financial assets, we debit our financial assets account and we credit either cash or another financial asset. If we're paying for it with something else, however, when we want to recognize interest income from our financial assets, we need to distinguish between the different categories. So if we have financial assets at amortized cost, the interest income is recognized using the effective interest rate method. So you're going to take your carrying amount and multiply it by the effective interest rate. Then recognize that amount in profit or loss. If we have financial assets at FVOCI, interest income is recognized in profit or loss, so it doesn't matter what the fair value is. We're just going to take the carrying amount and multiply it by the effective interest rate, then recognize that in profit or loss. Now, if we have financial assets at FVTPL, interest income is recognized in profit or loss, but it's based on the fair value of the financial asset, so it's the fair value multiplied by the effective interest rate, and that gives us the amount of interest income to recognize. Also, if you have financial assets at FVOCI, you're going to recognize foreign exchange gains or losses in profit or loss. So if the functional currency of the financial asset is not the same as the entity's reporting currency, any changes in foreign exchange rates are recognized in profit or loss. Now, lastly, we need to talk about impairment. If our financial assets are at amortized cost, or FVOCI, they are tested for impairment using the expected credit loss model. However, if our financial assets are at FVTPL, they are not tested for impairment using the expected credit loss model. Rather, we're going to look for objective evidence of impairment. So, if we find any objective evidence, we would write off the asset and recognize an impairment loss in profit or loss. So hopefully that helps in regards to how you classify your financial assets under IFRS 9. Again, thanks for watching, and I hope you found this helpful.